The ATO collected $1.91 billion in unpaid super last year through 23,600 super guarantee cases. And surprisingly, it wasn't necessarily from businesses trying to dodge their obligations, but instead from employers who simply didn't understand the rules. So, to help you avoid the same fate, I'm going to break down exactly what you need to know about super guarantee payments. Specifically, when you must pay super, how to calculate it correctly, which payments count towards super, what happens if you get it wrong, and how to prepare for payday super. Let's start with the basics. The Superannuation Guarantee, or SG, is the mandatory contribution employers must make to their eligible employees' super funds. This system was introduced in 1992 to help Australians save for retirement. The key points that every employer needs to know is that 1. Super is paid on top of an employee's wages. 2. It must be paid at least quarterly. 3. Payments must be made to a complying super fund. And 4. Late payments can result in the super guarantee charge, which is a penalty for failing to meet your superannuation obligations. As of July 2024, the SG rate is 11.5%, and this will increase to 12% from July 2025. Based on the current legislation, there are no plans to increase the superannuation guarantee rate beyond 12% after 2025. The rate is scheduled to remain at 12% for the foreseeable future and is generally accepted by governments as the appropriate level needed to meet the basic needs of Australian retirees in the future. In terms of the eligibility requirements, superannuation must be paid for all employees who are full-time, part-time or casual workers, temporary residents, company directors, family members working in the business, or receiving a super pension or annuity while working. Previously, the super guarantee was only applicable for those who earned more than $450 per month, but this threshold was eliminated in July 2022. Employers must now pay superannuation guarantee contributions for all eligible employees regardless of how much they earn in a month. The only remaining age-related restriction applies to workers under 18 years old who must work more than 30 hours per week to be eligible for superannuation payments. Other than the age-related restriction, the SG system does introduce a maximum contribution base, which sets a limit on how much superannuation guarantee an employer must pay for high-income earners. When an employee's ordinary time earnings exceed the current quarterly cap of $65,070, you are no longer required to pay a superannuation guarantee on the portion of earnings above this amount. Let's look at how the maximum contribution base works in practice. When an employee earns more than $65,070 in a quarter, their employer only needs to pay super on earnings up to that amount. For example, if someone earns $80,000 in a quarter, their employer only needs to pay super on the first $65,070. At the current rate of 11.5%, this means the maximum required super payment would be $7,483.05. The employer doesn't need to pay super on the remaining $14,930. You'll see that I mentioned that these calculations are based on what's called ordinary time earnings, basically what someone earns for their normal hours of work. This includes things like regular wages and some allowances. We'll take a closer look at exactly what counts as ordinary time earnings in the next part of this series, as it's quite important to understand. But first, let's look at how super payments affect your business's operations. Superannuation payments are a key part of running payroll, and they affect several aspects of your tax and reporting obligations. For starters, the super contributions you make count as wages when it comes to payroll tax. This means you need to include both regular super payments and any salary sacrifice super arrangements when you calculate their payroll tax. It's worth noting that this applies even if the employee's super is paid to different super funds. The good news is that when you pay super contributions on time, you can claim them as a tax deduction in your business tax return. This includes regular super guarantee payments and any catch-up payments you make before the quarterly due date. Now, every time you run your payroll, you need to report your super obligations through Single Touch Payroll, STP. This system tells the ATO about wages paid, tax withheld, and super guarantee amounts. Most accounting software platforms now include STP features as its mandatory requirement for businesses. Looking ahead, there's a big chance coming in July 2026 when you'll need to pay super on payday rather than quarterly. The reason behind the change is because in the 2022 financial year alone, there were over 500,000 cases where employers didn't pay enough super and more than 200,000 cases where they didn't pay any super at all. This led to workers missing out on about $3 billion in retirement savings. Currently, there's about $17.8 billion in unpaid super across Australia, which shows just how big this problem is. By moving to a system where super is paid with wages rather than quarterly, the government expects to see better outcomes for workers. When super is paid more frequently, it starts earning investment returns sooner. For example, a 25-year-old worker on an average wage could end up with around $6,000 more in their super by retirement just because their super was paid fortnightly instead of quarterly. The new system will also make it easier for workers to keep track of their super payments since they'll be able to see them coming in with each pay. We recently hosted a webinar on the specific impacts of payday super, which I'd recommend you watch, so I've left the link in the description box below. Otherwise, that covers an overview of the super guarantee fundamentals. In the next part of the series, we'll go into a bit more depth about employee eligibility requirements. And later on in the series, we'll cover OTE calculations, choice of fund requirements, salary sacrifice arrangements, as well as your reporting and compliance obligations. So make sure you're subscribed and stay tuned.